Good afternoon, everyone. Thank you again for joining us for our first annual Planned Giving Oscars webinar. I'm Jen Lennon. I'm the Marketing Communications Specialist at the Stelter Company. Stelter is hosting this complimentary webinar for you today. I'm excited to introduce our presenter, Lynn Gaumer. Just quick before I do, I just wanted to say a few words about the webinar series. So as an expert advocate for asset-based giving, Stelter is committed to providing innovative solutions and education for our industry, and we pride ourselves on being a bridge builder for the nonprofit community. So we're happy to host this complimentary webinar, as well as a whole slate of webinars throughout the year to connect you with experts from across the country to assist you in maximizing revenue across your development portfolio. So today's webinar is the first in our 2023 curriculum. We have a wonderful lineup set up this year with presenters such as Russell James, Margaret Holman, Phil Purcell, and Wayne Olson, to just name a few. We host about one webinar a month, so watch your inbox for your personal invitation, or you can always visit us at stelter.com/webinars to register. So now back to the presentation today with Lynn Gaumer. Lynn is the Senior Gift Planning Consultant for the Stelter Company. She joined us all the way back in 2011. Prior to that, she was an associate attorney for 10 years with the Duncan Law Firm in Des Moines. She authors our popular publication, Expert Insights, which if you're a Stelter client, you receive. It highlights trends and research in planned giving, and she's also been published in Planned Giving Today. She earned her bachelor's degree in economics and communication studies from the University of Iowa and her law degree from the University of South Dakota School of Law. She's a board member and past president of the Mid-Iowa Planned Giving Council here in Des Moines, and she is the chair of the National Association of Charitable Gift Planners Leadership Institute. And with that, I'm going to pass it off to you, Lynn. Thank you so much for being here.
Well, thanks, Jen. Again, I am your host for this year's Planned Giving Oscars, and I'm delighted to be here. We are just going to have a little bit of fun here today. So, but before we talk about our award winner, the Charitable Gift Annuity, I did want to recognize the nominees. So the nominees, beneficiary designations, of course, CGAs, donor advised funds, gifts in a will, gifts of appreciated assets, and qualified charitable distributions. So for gifts in a will, this by far is the most popular planned gift type. Depends on what research you look at, but anywhere from like 80 to 90% of planned gifts are gifts in a will. So they very much remain popular to this day, even though we're focusing on the gift annuity. Beneficiary designations are a close second. Both of these types of gifts are gifts made after a lifetime. And when we think about the economy today, especially with the most recent news about some bank failures, we've got the stock market struggling a little bit, where inflation is still top of mind. Some donors are saying, they would love to leave a legacy. They would love to support your organization, but maybe now isn't the time. So gifts in a will or beneficiary designations give that donor a great opportunity to certainly recognize your organization, but maybe just not now in an uncertain economic environment. Donor advised funds continue to surge in popularity. I just pulled the 2022 National Gift Annuity or National Donor Advised Fund Foundation report, and just some little tidbits from National Philanthropic Trust. $234 billion in total charitable assets for donor advised funds. Grants from donor advised funds to charitable organizations reached a new high at $45.74 billion, representing a 28.2 increase since 2020. The number of DAF accounts have increased to over 1 million. And so these donor advised funds have continued to serve. I encourage you to continually promote these in your marketing materials. And not only what a donor advised fund is, because they've become so popular, many donors know what these are already. So you may want to talk about kind of like next steps. What else can you do with the donor advised fund, such as put your organization as a beneficiary, or have the donor name their children as successor agents so they can continue on their legacy. So there's lots of other things you can do with the donor advised fund too, which you can certainly promote internally. We call that DAF 2.0 content, but it's something that you definitely want to continue on and promoting in 2023. Gifts of appreciated assets. I know the stock market has struggled a little bit, but that doesn't mean that that individuals do not have appreciated assets in their stock portfolios. If you take a look at maybe Apple stock in the 1990s or some of the other stocks, 10 years out, 20 years out, there are still substantial gains in the markets today. So there's gifts of appreciated stock are still very much on the table, and don't be afraid to promote them. Qualified charitable distributions continue to be on the rise, especially with the current expansion that just happened on January 1st, and we're going to talk about that a little bit later. But these are great gifts to make an immediate impact on your organization. And so for those 70 and a half and older who have IRA assets. So make sure you continue to promote all of these gift types in 2023. But for today's webinar, we're going to focus on the winner, which is the Charitable Gift Annuity. So let's take a look at it. Whoops. I'm going to go here. Okay, so Charitable Gift Annuities on the red carpet. So here's our agenda today. First of all, we're going to take a look at our award winner. This webinar has been designed for beginner to intermediate level plan givers. So I just want to make sure that everyone's on board. So we're just going to take a few slides to make sure that everyone understands what a gift annuity is. And then why CGAs deserve, my Oscar. It's a titanic opportunity for your organization and your donors. And we're going to find out why. Then we're going to look at the funding options. Of course, there's the traditional funding options of cash and appreciated stock, but now we have a new option to fund with IRA assets, and we're going to take a look at that. And then go into, which option is best? Which option should you be talking with your donor about, based on certain criteria? So we're going to take a look there. And then some common questions and next steps around the QCD CGA option. I receive a lot of questions about it. And then most recently, like, okay, I've got it. Now, what do I need to do? How do I need to change those CGA agreements and things like that? And then finally, we're going to end with a backstage interview. If you don't know Johnne Syverson, he's a legend in the plan giving industry. And we're going to talk about, especially to those of you who either don't have CGA programs or have CGA programs who have struggled in the past, we're going to talk to him, and I'm going to go backstage and interview him, talking about third-party administrators and CGA turnkey solutions. So what is a gift annuity? Well, a gift annuity, very simply, is a donor gives cash, appreciated property, or even now a qualified charitable distribution directly to a charitable organization in exchange for lifetime payments to your from your organization. It's a simple agreement, and it's formed between the donor and the charitable organization. Usually it's about only 3 pages long, and I feel like it's very simple. The donor, of course, is welcome to run it by their financial advisor or their attorney, but in general, it's a very simple agreement. And then after the annuitant's lifetime, either 1 or 2 individuals, the balance is used by your organization to support its mission. So why are they even popular? Well, it's simple to implement, that's for sure. We just talked about a fairly simple agreement. There's no trust needed, so an attorney really doesn't need to get involved to draft the agreement. Steady annuity payments for life, so a donor can rely on these payments throughout retirement, and they can never outlive their payment stream. Market fluctuations and economic downturns do not affect the payments. I know when when we first hit in March 2020, and in April, the stock market had a huge decrease. A lot of CGA annuitants were coming forward and saying, what about my payments? Well, those payments are fixed at the time of the gift, so it doesn't matter what happens in the economic environment. So here's just a little infographic for those who are more visual. The donor donates cash, securities, or QCD. Typically, you'll have a gift acceptance policy. Most of them say about 60 and over. This particular donor is 75. And then based on the current rates, the payments are 6.6 for this 75-year-old donor. And then the remainder goes to your organization. Statistically, that's about 50% based if you use the ACGA rates, which I certainly recommend. So let's take a look at the donor profile. Who exactly is giving CGAs? Well, the ACGA, the American Council on Gift Annuities, creates a survey about every 2 years. And based on this survey, the average CGA donor is 79. The gender is fairly split, 52% female, 48% male, and most annuities are immediate. You see that at 70%. Now, a question that they had in this most recent survey is, what about giving after an individual puts a gift annuity in place? Does it increase? Does it decrease? Does it stay the same? Well, I thought this was an interesting statistic. According to the ACGA survey, 97% of respondents stated that a gift annuity had either increased their annual giving or had no impact. So it's definitely something. So for like any major gift officers out there, don't be afraid to promote charitable gift annuities, or quite frankly, any other plan gift, because we know from research and from Dr. Russell James that once that plan gift is put in place, typically annual gifts will increase. Okay. And I strongly encourage you to follow the gift annuity rates the suggested maximum rate set forth by the American Council of Gift Annuities. 96% of charities follow these rates. And it's important that to minimize your liability and your risk to follow these rates. So why does the CGA deserve the Oscar? Let's look at it. Well, I think it hit the trifecta, really. It had 2 rate hikes in 2022, one in July and then one at the very end that took effect on January 1st of this year. Rates are higher than they have been in over a decade. Another reason is that we have the Secure 2.0 or Legacy IRA Act, which gave us a new option to fund CGAs using an individual's IRA assets. This individual needs to be 70 and a half and older, and they'll basically make a qualified charitable distribution of up to $50,000. We're going to go into the details about this in a little bit. And then let's take a look at demographics. We have an aging population, which is the perfect age to set up a gift annuity. So when it comes to gift annuities, it could feel like everything, everywhere, all at once. So let's take a look first at sample gift annuity rates. I created this chart for you so that you could see how gift annuity rates have increased in the last year. So just a year ago, if an individual was 60 years old, the rate would have been 3.9%, but now we're a whole percentage higher at 4.9%. And you can take a look at this in more detail, but you see how it's really, anywhere from a percentage to maybe a little bit over a percentage difference between rates from just a year ago. Here's the rate chart for 2 lives and how it has increased. Again, we're seeing rates at typically over 1% difference between what the current rate is and what the rates are or have been just a year ago. So let's take a look at the second point in the trifecta. The Secure 2.0 or Legacy IRA Act. So what did this do? So at the end of December of last year, President Biden signed into law some legislation. And the Secure 2.0 is much broader than this, and we certainly don't have time to be talking about all of that today, but there are 3 bullet points that I want to make sure that you are aware of. First of all, it raised the required minimum distribution age, or the RMD age, to 73 in 2023. So if you're using last year's materials and you reference that 72, so make sure that you update your materials on that, because last year it was at 72. This year it's at 73, and it's going to stay there for the next 10 years until it reaches 75 in 2033. We've already talked about and then for the QCD, the amount right now is $100,000. That is going to adjust for inflation beginning in 2024. So right now, an individual can give a qualified charitable distribution who's an IRA owner, 70 and a half, up to $100,000. But beginning next year, it'll be a little bit more than that. It will adjust for inflation. And here's our one-time election. This was kind of the big one in the Secure 2.0 Legacy IRA. This is individuals can now make 70 and a half and older can make a one-time election of up to $50,000 to fund a CGA with their IRA assets. And we're going to get into a little bit more detail on that. And finally, the third reason that I have for naming CGAs as my Oscar for 2023 is the shift in demographics. Take a look at the mature or the silent generation. It makes up 23% of the population. These individuals are 78 and older. And what did I say about the donor profile? Most donors who create CGAs are 79. So they are in this generation. So it's a perfect time. And so for individuals of this age group to be creating CGAs. And now let's take a look at the baby boomers. They make up a little over 21% of the population and control 80% of the wealth in the US. By 2030, all baby boomers will be age 65 and older, which is, of course, your perfect age for a CGA, right? And you have the late boomers who are still in their prime earning years right now, but they're starting to look ahead towards retirement. So they're thinking, okay, if I retire at a certain age, what is that going to look like? What is my income going to be? I'm still charitably inclined, so what can I do? And so a CGA may be the perfect option for them. So let's take a look at trends and opportunities based on demographic shifts. So according to a recent survey, 43% of prospects in a respondent's marketing databases were over 70 years old. So that's perfect for CGAs. It's also perfect for qualified charitable distributions. So, so take a look at your databases and see if you can take out, individuals 70 and older and see how many individuals fall into that category. Approximately 10,000 baby boomers are turning 65 every single day. Again, perfect opportunity for CGAs and a perfect opportunity to plant that seed for qualified charitable distributions as well. The 70 to 80-year-old age group is the fastest growing bracket in the US. And so as this age group continues to grow over the next 10 years, your organization will have unprecedented opportunities to attract valuable new donors and promote gift annuities. And also, I'll say qualified charitable distributions as well. So let's take a look at our funding options. So this is traditionally most CGAs are funded with cash or appreciated stock. So I just wanted to go over that first. So how does it work? So an individual will transfer either cash or appreciated stock to your organization. They do qualify for an income tax deduction. They'll receive lifetime payments, which are tax favored throughout the annuitant's life expectancy. And if they give appreciated stock, they will pay no capital gains tax when the appreciated asset is given. Now, the capital gains will be drawn out over the individual's life expectancy, but they still are able to minimize those capital gains. So what happens at your organization? Your organization will sell the asset, pay no capital gains when selling the asset, and pays the donor or annuitants a fixed amount annually for life. And eventually, hopefully use that residuum as to support your mission. So let's take a look at a donor example. We have Meryl here. She's 73 years old, and she has a strong connection to your organization. And she is, even though she's Meryl Streep, she's concerned about her retirement income. So she's going to donate $50,000 worth of appreciated stock that she originally paid $10,000 for several years ago. So what happens with Meryl? Meryl receives a little over $3,000 in annual payments. A portion of her annual payment is tax-free income. A portion is ordinary income. And because she donated appreciated stock, she has a portion of capital gain income throughout her life expectancy. Once she reaches her life expectancy, all of this will become ordinary income. Okay, the fixed amount of 6.3 is determined at the time that she creates that gift. And your organization is hopefully following those suggested maximum rates by American Council on Gift Annuities. And she receives a charitable deduction of just under $22,000. Now, this is all based on a 4.4 CMFR rate. You see that below. That is the current March rate. We have not received April rates yet. Keep in mind that these rates change monthly, and an individual can use either the current month's rate, so the March rate, for example, or the previous 2 months rate, depending on which would be most advantageous to the donor. So the previous month is actually 4.6%. So if the donor is looking for a little bit higher charitable deduction, they might want to use that 4.6%. If they're focused a little bit more on the tax-free income portion, they'll want to use the lower amount, which is the 4.4%. Now, I wanted to talk with you about the Impact CGA. This is a twist on a traditional CGA. So what I have found is that donors, even though they give the gift and create the gift now, in their minds, they think that they are making an impact now, when in reality, the CGA assets are used later at some point in the future. So what about for the donor who says, well, I want to make an impact now. I want to pledge a certain amount of money, or I want to contribute to this campaign and make it count now. Well, there's what's something called an Impact CGA, and it funds, an Impact CGA is funded with cash or appreciated stock, and the individual will choose how many years at the time they create the gift annuity, how many years they would like to immediately impact that organization. I will say that it's typically 3 to 5 years. In doing so, they'll qualify for a larger income tax deduction. And this benefits if current deductions currently fall below the standard deduction. It can satisfy a pledge, it can contribute to a campaign, and of course, it makes an impact now. So let's take a look at what that would look like. So let's compare Meryl's immediate CGA with an impact CGA. So here I just use 75. So Meryl decides, after she creates her CGA we just talked about, she's now going to do an impact CGA for an additional $50,000. So she is going to defer her payment, or she's going to make sure that her payments for the first 5 years go back to your organization. So her annual payment is $3,300, and that money for the first 5 years of the annuity payments will go back to your organization for immediate use. And in this example, that's $16,500. You see how much larger her income tax deduction is based on that 4.4 CMFR. So if you're looking for like a new twist for between, the traditional CGA, and even when we talk about the new funding option, those all benefit your organization at a later point in time. But that impact CGA makes a difference now. And I just love it when we combine in our marketing material all the benefits of a CGA, but if the individual wants to make an impact now, we will combine that with an impact CGA. So basically, it's make a difference now, make a difference tomorrow in the same brochure, which is your perfect blended giving opportunity and conversation. So I have a sample donor letter for you. It will be sent to you with the recording or available in a few days on our website that will talk about this type of impact CGA. Now, there's also what's always been available is that an individual can always assign payments back to the organization. They're just not committing up front. So if an individual says, well, I'd like to do that, but I really don't want to commit to 3 to 5 years. I'm just not sure about my financial situation. They can certainly take their payments and then turn around and make a gift, right? So that's something that's always been an option for them. So I just want to make sure that there's options to use CGAs and make an impact now. So let's talk about funding a CGA with IRA assets, which is our new option here. So with this, if your gift acceptance policy says, we offer CGAs for those 60 and older, but you're going to have to amend that a little bit. That would be correct for CGAs funded with cash or other appreciated property. But if you're funding it with IRA assets, the individual needs to be 70 and a half and older. So homework time, you're going to need to look at those gift acceptance policies and make sure that you're incorporating this into those policies to make sure that that everyone on your current staff and then your future staff understand that there's a difference here. Now by making this transfer, a qualified charitable distribution to create a CGA, the individual will not have to pay income tax on it. It works just like a QCD, except they're funding a charitable gift annuity, okay? Individual receive lifetime payments, which are ordinary income. This is a little bit different from Meryl's example, right? Because with that example, we had part tax-free income, we had part ordinary income, we had even capital gains income, but here all payments are ordinary income. This is great for the donor who wants to use their most heavily taxed assets, and of course they can, at 73, they can satisfy all or part of their required minimum distribution. So from your organization's standpoint, you need to pay either the donor or the donor's spouse. With a traditional CGA funded with cash or appreciated stock, remember that the annuitant could actually be anybody who qualifies, from an age standpoint. It could be like the donor's mother, it could be the donor's sibling, it can be an older child. But with this particular rule, it's the donor or the donor's spouse, nobody else. So there's some restriction there. And then, of course, your organization can use the residuum as part of your mission. So let's take a look at Jack here. Jack is 85 years old and has a strong connection to your organization, and he would like to use his most heavily taxed assets to make a gift. So he's going to do a one-time election using his IRA assets and transfer $50,000 to fund the gift annuity. So what does this look like? He will receive over $4,300 in annual payments, and all of his payments will be taxed as ordinary income. He satisfies all or part of his required minimum distributions for the year, and he'll receive, based on his age, an 8.7% payout rate. And he does not receive a charitable deduction. That's the same with like a qualified charitable distribution. You don't get an income tax deduction on top of it. So when this first became law on January 1st, I received a lot of questions on this gift type. And so I'm just highlighting them here. So let's just take a look. So one of the questions I got was, well, can somebody take the QCD of $50,000 and maybe combine it with cash or other assets and create a larger gift annuity? And the answer to that is no. The QCD has to be its own CGA, and so you can't start combining other assets into a single gift annuity. Of course, they can do two different gift annuities if they wish, and do one funded with cash and appreciated stock, and one funded with the qualified charitable distribution from an IRA asset. Second question that I get, these are my top questions. Can spouses each contribute up to $50,000 from their respective IRAs to fund one joint IRA? The answer to is yes. So if they each have an IRA, they can contribute $50,000 and create one joint CGA. Now, the actual language for this new law is that it's actually like a life income gift, so which also include charitable remainder trusts. But even though the new law allows for this option to fund a charitable remainder trust for up to $50,000, honestly, it's not really practical to do because of the cost setup. Obviously, an attorney will need to draft the trust, the ongoing administration. Sometimes there's a professional trustee involved who will need to be paid. So for $50,000, it's really not practical to use this to set up a charitable remainder trust. And you can't use it to add to an existing trust. It would have to be to a new CRT. So really, I recommend that your marketing materials really focus this new law on the charitable gift annuity. So can an individual make a $100,000 QCD gift and a $50,000 QCD CGA gift in the same year? And the answer is no. Right now, many experts believe that you cannot combine this in a single year. So what an individual can do is maybe make a one-time election of $50,000 and do a CGA, and then an additional $50,000 outright QCD gift for a maximum of $100,000. So they cannot add the two together and create a $150,000 gift, basically. So again, one-time election of $50,000, and if they want to give more, they can certainly do another $50,000 outright QCD gift. Can an IRA owner, 70 and a half and older, create more than one CGA as long as the aggregate amount does not exceed $50,000? Yes, but it is not limited to a single gift, but it must be completed in the same year. So for example, an individual who wants to give $25,000 to your organization and $25,000 to another organization, all within 2023, they can certainly do that. But if they choose, they can't, if they choose to only use $25,000 this year and make that one-time election, they can't go next year and do another 25,000. So as long as they do it all within the same calendar year, they can do that. So just keep in mind that that's something that, you may want to ask that in the conversations is, have you made your gift, have you made this type of gift yet this year, just to make sure that they don't go over the $50,000, or, in subsequent years. So when you talk to individuals next year about it, did they make this election for this year, for 2023? If the answer is no, then of course they can make it for next year. So donor profile for a QCD CGA. Well, of course, we all know that CGAs, first and foremost, are for those for the charitably inclined. They're not a financial instrument or anything like that. So they are for the charitably inclined. I would say those who have built a large IRA account balance and are looking to draw down those funds to lower future RMDs and possibly, their ordinary income as well in future years. It really benefits the taxpayers who take that standard deduction, who wish to minimize taxes, and of course are interested in a fixed stream of income. So those are the individuals. And of course, 70 and a half and older, right, and who have an IRA. So make sure that, take a look at your donors and see, who kind of falls within these parameters. So which funding option is best for your donor? Well, I think it's up to you to present the options to your donors. They can work with their financial advisors. Now is a great time because we're starting to, well, we are in tax season, but we're getting closer to when it's the filing date, right? So, think about it. If an individual would like to fund a CGA who's, not quite 70 and a half yet, and they're in that 60 to 70 year old range, maybe they just want to fund a traditional CGA, or they want that partial income tax deduction, or they want those partial tax-free payments. So what is important to your donor? That's what you're going to have to, talk with them, steward them, ask those questions. If they're wanting to use more than $50,000, then, maybe this traditional option is best for them. Or if they want to defer their gift. So if you fund it with IRA assets, the payments must begin no more than 1 year from the date of the gift. So deferred options are not available. So if an individual starts out and says, well, I'm 60 now, I want to defer it to 65, then the conversation is more focused on funding it with cash and appreciated securities. Now, IRA assets, again, 70 and a half and older, right? And there's no income tax deduction. Of course, this benefits those who take the standard deduction. All payments taxed as ordinary income. So if your donor is looking for partial tax-free payments, then they're, in the traditional side. And this is more restrictive as far as who the annuitants can be. It must be the donor or the donor spouse, where annuitants on a traditional CGA could be a spouse, another partner, a sibling, a parent. It could be a wide range of individuals. And of course, it's limited to $50,000, although this will also adjust for inflation beginning in 2024. So this will increase incrementally. So again, with your marketing materials, you're going to have to watch for that and make sure that you're addressing that as well. And then again, I just said, payments must begin no more than a year from the date of the gift. So deferred and flexible deferred gift annuities are not available for the IRA assets. So why you should highlight the new CGA option, QCD CGA option? Well, it's a reason to connect with donors, right? This is the shiny new penny. It's always great to have something else to talk about. These conversations could lead to additional gifts. They obviously offer steady, fixed retirement income. One of the barriers that I've heard over the years prior to this law's enactment was that, they're taking with traditional funding, they wanted to use their IRA, but in a QCD, but yet that was their retirement. Well, they now, with funding a CGA option, they can use it to fund a CGA and then also receive retirement income in return. So it's definitely breaks down some of those barriers. Just a little marketing tip, with all the nuances that I talked about, the limited of $50,000, the age 70 and a half, only of it being available to a spouse and the donor. I recommend saying something along the lines in your marketing material. This option comes with special rules, so connect with us to learn more. And that invites conversation. So just kind of make sure that you're not promoting these options together, because they do have different benefits. You have to be careful with that. So next steps for QCD and CGA gifts. So I've been getting a lot of questions just recently about, well, what are my next steps? So I understand the law, I get it, but what do I need to do now? So the first thing to do is you need to update your CGA agreements to reflect that it's non-assignable. So these types of gifts have to have a non-assignability clause. Your traditional agreements most likely will have an assignability clause where the payments can be assigned back to charity. But with this gift, you can't do that. So make sure you update your CGA agreements. That's number one. That's your first homework. Your second one is to review your state registrations. And ACGA just put out a tweet a couple hours ago about New York. And there's several other states that I have on my radar that require you to file revised forms for review and approval. And I believe those states are Alabama, Arkansas, California, Maryland, North Dakota, New Jersey, New York, Tennessee, and Washington. If you're in any of those states, I for sure want you to review your current state regulations and make sure if you need to file updated CGA agreements to have on file, then make sure that you take care of that sooner rather than later, because you'll need approval prior to issuing any QCD CGA gifts. There could be more states out there, so just make sure that you check with your individual state regulations. And then create a new acknowledgement letter for these gifts. Of course, you want to state that no goods and services were in response to this gift type, and just reminding the donor that they don't get a charitable deduction. So now say yes to the CGA. And here's comes my backstage interview. So a lot of questions that I get in my role here at Stelter is that, we would love to have a CGA program, but what? Well, the risk is too high. We have had, we issued CGAs in the 1990s and we got burned. A lot of them went underwater. So our current CEO, CFO, board does not want to have a CGA program. But yet I'd love to take advantage of all these great things that you're saying, Lynn, because we would love to have a CGA program, but, we don't want the risk. Or maybe, you don't want to register in certain states, or quite frankly, in any state. You just don't want to go through that process, maybe because you don't have the resources, whether that's either people or time. So I wanted to address this. And according to a 2021 ACGA survey, the percentage of nonprofits that now outsource their gift annuity administration has increased dramatically to 58%. So in order to address these, I've invited to my backstage interview, Johnne Syverson. And I've worked with John for the last decade or so. John is a legend in the industry. He has over 45 years of experience in helping individuals with philanthropy. He's the current Vice President of Gift Annuity Services for the National Gift Annuity Foundation. And he, quite frankly, has helped many of our clients with their CGA administration and turnkey solutions. So John, are you ready for your backstage interview?
Oh, I'm ready. And by the way, Lynn, Meryl Streep and Jack Nicholson send you their best regards. They're honored to be part of the program today. Thank you for having them.
Oh, thank you. Thank you, John. That's awesome. Well, John, thank you so much for joining us today. And can you just explain to me, first of all, the difference between a CGA administrator, where a nonprofit would outsource their administration, and a CGA turnkey solutions program?
Yeah, there's a real distinct difference. It's fairly easy to find an administrator. That you could find an accounting firm, you find a financial institution that would be glad to keep records and books and manage the funds and send 1099s out to the donors, etc. But what you aren't transferring there is the legal and financial liability associated with every CGA contract. And that includes making certain that those payments are made to that donor for the rest of their life, even if they live to 115 years of age and you've exhausted the amount in their annuity account. That's where the CFOs and the finance committees of these nonprofits shudder. They hate gift annuities for that reason. You're not transferring that liability when you just outsource the admin. Where a true turnkey solution says you outsource everything, the assets and the liabilities move from your balance sheet to the balance sheet of another nonprofit that's in the business of providing gift annuities for other charities. It becomes basically a pass-through. Your organization ends up getting the residual value at the death of the donor, but between now and then, you don't have any responsibility to make payments. If they exhaust their gift annuity account, the donor still receives funds, but you're not digging into your operating funds to pay those. The issuing charity has to supply that. So that's the big difference, is offloading the financial and legal liability associated with each CGA contract.
Okay. So, so tell me how exactly it works. So if I'm an organization who's maybe, smaller to medium size, and I don't have the resources, and yet all of a sudden I have a donor who would like to take advantage of this QCD CG opportunity. I'm not registered. I don't have any resources to be handling payments or anything like that. Tell me how it would work. Walk me through that scenario.
Well, as you know, that you send me all kinds of those charities, because I got one yesterday from you, and it's real common because the donors are asking them, can you do CGAs? And if the answer is no, they go somewhere else to find it, okay? And so to work with us at National Gift Annuity Foundation, which was founded about 10 years ago by Brian Klons at Charitable Solutions in response to a need that he saw, to provide a turnkey solution for charities that either could not or should not be offering their own. So what you simply do is make an arrangement with National Gift Annuity Foundation to refer your donors to them. But what National Gift Annuity Foundation does is it keeps you in the loop. You maintain the donor relationships. We provide you with all the necessary forms, et cetera, to get the donor involved and get set up. And we operate as the back room, kind of like we're backstage today. National Gift Annuity Foundation is your back room to do all the legal and accounting and financial work and make all the payments, send out the 1099s at the end of the year, and make certain that if the annuity runs dry, use our assets to make payments to the donor who lived to 115. But assuming there's any residual value left at the donor's passing, 100% of that passes right through to you as the named charity, just like it would if you were named as the beneficiary of an IRA account, a life insurance policy, or an estate.
Okay, and so there's no liability. There's no contracts as far as if I'm a nonprofit, I don't have to set up 5 annuities a year or anything like that with you, correct?
Correct. In fact, that's an oft-asked question. Well, send us your contract so I can have legal look at it. There's no contract. Each individual gift annuity is the contract in which 3 parties are named: the issuing charity, National Gift Annuity Foundation, the donor annuitant, your donor, and your charity as the remainder beneficiary, just like it would be named in a life insurance policy or an IRA. So that each individual annuity is the contract. We can do 1 or we can do 1,000. Makes no difference.
Okay, and the donor still receives all the same benefits. So like if the donor donated appreciated stock, they'd still get, an income tax deduction and minimizing their capital gains, just like everything like we talked about today, correct?
Everything's exactly as you discussed, including we follow absolutely ACGA rates. We will not deviate from the ACGA rates to protect both us as the issuing charity and you as the residual beneficiary.
Okay. And then, so what fees do I pay as a nonprofit? Do I pay you some fees to handle this, or how are you paid, John?
Here's what the finance committee loves. You don't have to put us in your budget as a line item. You never send us a check. The National Gift Annuity Foundation takes its fees out of the assets of the CGA, just like a mutual fund company does when they do their management work. So we take out 1% per year for administration and state compliance, which is a big deal because we're registered in all 50 states. You don't have any state registration for where your donors live. And then number two, we do the money management ourselves, holding that all our funds at Charles Schwab in indexed ETF accounts, which are very low cost, according to the ACGA's recommended asset allocation model.
Right. And what do you have minimums then? Is there a minimum age or a minimum amount that the donor needs to do?
Yes, in fact, the minimum age is lower than most, it's 55. And you might say, well, why are you issuing gift annuities at 55? Very few are issued at that age, but I like 55 from a planning perspective because we also offer testamentary charitable gift annuities, which can be named the beneficiary of very large IRAs. So at the death of the donor, their heirs don't have to take their IRA assets as an inheritance within 10 years or face a 50% penalty from the IRS. They can now, just like they used to be able to do before the law changed in 2019, they can stretch out their tax liability by ending up with a CGA on the life of the heir funded with the deceased IRA account, which could be several $1 million. But the problem is that the heir might not be 60 or 70, they might only be in their 50s. And a lot of these are adult children of people who are dying in their 70s and 80s with very large IRA accounts. So that's why we have 55 as the minimum age to start receiving payments. We can set up a deferred annuity for someone age 40, but the payments cannot start till age 55 or beyond. Minimum amount is currently $20,000. We're thinking about trying to raise that. There are still charities issuing gift annuities at $10,000. They need to examine their costs. I can tell you for certain, our break even for our cost in a gift annuity is $43,000. It costs money to operate these gift annuities because of all the administration that goes with it. Whether you're cost accounting for that by having your accounting department just taken on as another duty, which they hate, by the way, there are costs associated with it. So our 2% total is all in. That covers everything. So you never pay us a dime, and it does not, our fees do not affect the donor's payments one iota. They're going to receive the ACGA rate multiplied times their contribution amount.
Okay, so just to recap, I'm a smaller nonprofit. I don't issue CGAs right now, or I'm a small to medium-sized nonprofit who is not registered in all 50 states, and I have a donor who's interested in California. I'm not registered there, but I can contact you and have my donor. Now, do I work with you, or does the donor work with you?
No, you would work with us. We try to stay out of line with the donor, except if you bring us in complicated cases, we'll get on a three-way. They're your donors. They're not our donors. We're just your back room. We're helping you implement something that you would have had to say no to because you're not registered in California, Washington, Alabama, Maryland, New Jersey, and New York. In fact, we do this work for very large universities that will not get registered in those states for all the hassle that goes with it. So they do all their own gift annuities except for donors that live in those states. Again, they can do one or they can do 1,000. There's no difference. Easy.
Yeah.
A small charity that has never issued a gift annuity, my promise is if they'll spend an hour with me on a Zoom call, after that hour, they'll have all the materials they need to write their gift annuity that same day. And we've actually done that before. It's very, very simple. It takes 1 hour of your time and you can be up and running because National Gift Annuity is the issuer and has everything legally and financially in place. You don't have to do anything. All you have to do is know how to sit in front of your donor with a proposal that either you prepare or we prepare. We happen to use Crescendo for making illustrations. And so there you go. It's really, really easy and simple. Our most common complaint is it's too good to be true. How can you do this? Well, it was Brian Klonz's vision 10 years ago said, this is a need, we need to fulfill it. And because we're already part of Charitable Solutions and his Decamite Foundation, that's what makes this possible. If we were to start this on our own, you couldn't do it, not at 2%. there's not enough money in it. That's why many organizations, a lot of community foundations used to do this for other charities, and they found the same thing. We can't take on all that liability and all that risk and not get anything out of it. There's just not enough to go around.
Yeah. So I'll just, just a case in point here. So I was working with one of our clients who was not registered in a certain state, had a donor who was interested in a gift annuity for $10,000. And he called me and said, I have a donor interested. We're not registered. I'm ready to say no. And I said, oh, no, don't say no. Here's what you can do. So basically talk with John. Now, and I said, but their minimums are $20,000. So, I'm not sure how your donor will react to that, but, this is an option for you. So the plan giving officer went back to the donor, explained the situation. So not only did he not say no to the gift, but the donor said, okay, that's fine. And he doubled his gift. So he went from, ready to say no to the CGA to doubling the gift, working with John and making a $20,000 CGA, and it worked out perfectly. Yeah. So that's just some things. We're out of time for this interview, John, right now. We're going to take a couple questions, okay, and then if we've got, so let's move along here. So thank you, John, so much for everything. You were very helpful, especially for those smaller organizations out there. Jen, do you have any questions that came in for either John or I? Oh, I have all this too. I forgot about this before my question. Did you want to
go through this?
Yeah, I'll just hit on this really quickly. So I just wanted to make sure that you were aware of all the resources that are available to you. The National Association of Charitable Gift Planners, as Jen mentioned, I'm chair of the Leadership Institute there. Wonderful way to get involved, network. They have an upcoming conference in early November in Chicago. And they're back to, really pre-pandemic numbers. So it was really fun this past October to be out and about with them. But just a great resources for you. The ACGA, I mentioned them numerous times. I strongly recommend that you join this organization. It has certain benefits. You would get any ACGA rates when they change. You would get early access to those rates. And it's just a wonderful way to get more resource information specifically on gift annuities. And this complete resource manual is I refer to this all the time. It's like $75, I think. You can order through PG Calc, and it has everything you need to know about gift annuities, including different funding options and things like that, and state regulations. So just great resources for you. Now I'll take questions.
Okay, we are out of time. I'll ask you just two really quick ones. I think you guys covered quite a bit in your interview with Johnny, but as far as registering, there's a lot of people confused about, do they need to register the nonprofit in the state where the nonprofit resides or where the donor resides, or both?
The donor.
Both. Well, yeah, so I would definitely recommend, since most of your donors are in the state that you're in, I would recommend that you register there, but it's also you register where the donor is at too. So
okay,
yeah.
And then just to confirm, if a donor uses their IRA to fund a gift annuity, is that just a one-time thing, once in a lifetime that they can do, or can they continue to do that?
Yeah, it's a one-time election. So if they do it this year, then as of the law is currently written, then, and they use that one-time election, then they are not eligible in future years. Okay. That is correct. So I did want to just mention one last thing. The ACGA reviews their rates twice a year, typically in April and November. So that's coming up here next month. So just look for an announcement from them. I suspect that CGA rates will stay the same for the second part of this year, but you never know. But that announcement should be coming in late April. So there you go.
Okay. And I apologize, we did not get to very many questions today. So Lynn and John have volunteered to take your questions personally. If you want to reach out to them, their emails are on the screen right now, lynn.gaumer@stelter.com and john@nationalgiftannuity.org. Another question, you will receive the handouts, you will receive the recording. I will send an email probably tomorrow to let you know when those resources are available for you to grab. So look for that. And if you have any questions about Stelter or our solutions, you can email myself at jen.lennon@stelter.com or visit us at stelter.com. And that's all we have for today. Lynn and John, thank you so much for being here. We had a lot of people in the questions area just commenting what a fabulous presentation this has been.
Awesome. Great. Thank you
Pleasure.
very much for doing everything you do for your communities and your donors. And if you have any questions, feel free to reach out to John and I. We'd be happy to answer them for you.
Okay, great. Thanks again. We'll see you next month. Have a great afternoon. Bye-bye.